Balance sheets are more than just columns of numbers. They provide a snapshot of your company's financial position at a specific moment. For executives, the balance sheet is a strategic tool that can highlight risks before they become threats. Take Bill Ackman's classic lemonade stand example. The balance sheet clearly shows how a surge in debt can quickly change the outlook for both lenders and equity investors. In this episode, you'll master 3 core areas: how the accounting equation underpins every financial statement, how to distinguish true assets from liabilities, and how to use these insights to guide smarter decisions. Understanding this foundation is key to interpreting the real story behind your numbers. If you're new here, please subscribe and like, because I share tips to help you improve your career. Let's break down the accounting equation, the backbone of every balance sheet: assets equal liabilities plus equity. This isn't just theory, it's the organizing principle behind every financial transaction your company records. When you purchase equipment using borrowed funds, you're not simply spending money. You're increasing your company's assets while simultaneously growing its liabilities, keeping the equation balanced. Think of it as a financial scale where every action requires a counterbalance to maintain stability. William Ackman's lemonade stand example demonstrates this in a practical way. The initial investment, part equity from investors and part debt from a bank loan, creates assets like cash and goodwill. As the lemonade stand operates, the balance sheet tracks the transformation. Cash is converted into inventory, equipment, and eventually, shareholder equity. Each transaction, whether it's buying lemons or repaying part of the loan, is meticulously recorded to reflect its impact on assets, liabilities, or equity. This approach shows how debt can be a tool for growth when managed within the framework of the equation, rather than a risk that tips the balance. Understanding the mechanics behind debits and credits is essential for keeping your financial records reliable. Tools like Kiyosaki's cash flow game illustrate how every debit has a corresponding credit, ensuring that your books always reconcile. When you grasp how these entries work together, you can quickly spot errors or imbalances that might otherwise go unnoticed. Reliable financial statements depend on this discipline. Without it, you risk making decisions based on flawed data. But the real value of the accounting equation comes from recognizing what changes in the balance actually mean. If liabilities start to outpace equity, or if your asset base erodes, it signals deeper issues, perhaps too much leverage or declining profitability. Microsoft's financial team, for example, identified a trend of shrinking equity relative to rising liabilities and responded with strategic share buybacks to restore balance before the problem escalated. This understanding lays the groundwork for a more nuanced look at what truly counts as an asset or a liability. Sometimes, what appears to be a valuable asset on paper could be quietly undermining your financial position. If you're finding this helpful, please subscribe and like, because it helps us create content that matters to you. Also, if you want to take your skills further, check out our executive education and executive coaching programs at execdeet.com. As an executive, distinguishing between assets and liabilities is fundamental to safeguarding your company's financial health. Not everything recorded as an asset truly benefits your business in the long run. The executive guide to this distinction starts with a simple but powerful question: does this item contribute cash flow, or does it require ongoing outflows? Robert Kiyosaki's example of a personal residence illustrates this well. A home you live in is a liability if it continually takes money out of your pocket through mortgage payments, taxes, and maintenance. It only becomes an asset when it generates rental income and puts money back into your business. William Ackman's lemonade stand further clarifies the dynamic between assets and liabilities. In his example, the initial cash raised from equity investors and borrowed funds is used to acquire the stand and inventory, assets that have the potential to generate revenue. Over time, These assets are either consumed or transformed as the business operates. The balance sheet tracks these changes, revealing how effective each asset is at driving value. Ackman's framework also draws a clear distinction between debt and equity. Debt is often considered safer because lenders have a priority claim on assets, but the returns are capped. Equity, on the other hand, carries more risk, but offers greater upside if the business succeeds. This interplay is visible in the lemonade stand's evolving balance sheet, where liabilities must be managed to avoid eroding the value created by productive assets. Intangible assets, like goodwill, also play a role. In Ackman's demonstration, goodwill arises when the lemonade stand's reputation or customer loyalty allows it to raise additional funds from investors at a premium, reflecting value beyond physical assets. This shows how some line items, though not tangible, can add to your company's equity position if managed strategically. A disciplined executive reviews each line on the balance sheet through this lens. Does it support ongoing growth, or does it represent a drain? Regular analysis of asset and liability ratios ensures your company's resources are working for you, not against you. This approach prepares you to identify changes that signal new opportunities or emerging risks. With this mindset, your financial statements become more than static reports. They become a source of strategic insight, setting the stage for deeper analysis and more informed decision-making. To close, focus on 3 actions that set effective executives apart. First, use the accounting equation as an early warning system. Track shifts between assets, liabilities, and equity to spot emerging risks. Second, classify each line item by its cash flow impact, not just its label. As Kiyosaki and Ackman's examples show, assets that drain resources are liabilities in disguise. Third, monitor key ratios regularly to maintain balance and inform strategic decisions. As Ackman's case demonstrates, don't leave your company's risk profile to guesswork. Apply the balance sheet test yourself next quarter. Download the free balance sheet checklist from the research link below to get started. Thanks for watching. Please subscribe and like because it helps us bring you more free videos. And if you're ready to grow your career, visit execbeat.com to learn about our executive education and coaching.